Good afternoon. So if you're worried about wealth concentration, and if you're not at all worried, then you probably shouldn't be in this room. Then one of the most immediately obvious solutions would be to tax the rich. So that's what we're going to be talking about in this panel. But I think it is worth thinking through before jumping to the apparently so incredibly obvious solution of taxing the rich, to think through exactly what one would want to achieve with taxing the rich. Is it simply about raising budget to spend on public goods? Is it about making sure they do not set a bad example with tax avoidance practices that might then translate into the tax morale of the general population? Or do we have more radical goals? Is it really about redistributing from the rich to the poor, or breaking the political power of the wealthy? And who exactly are we talking about when we say the rich or the super rich or the billionaires? We want to be precise about our language. And then why is it actually so difficult to tax the rich? What are the obstacles? Well, we could list them, but actually we've got a fantastic panel to talk about both why we might want to tax the rich, what public appetite there is for doing so, what tolerance we have for wealth inequality, and the obstacles to taxing the rich. Our panel is Patrick Sachweh, Professor of Sociology at the University of Bremen, who runs the Socium Research Center for Inequality and Social Policy, and has done a lot of work on the effects of inequality on solidarity and conflict, on welfare solutions. And today he will be talking especially about a cross-European public opinion survey that he's in the middle of this research on public attitudes to wealth inequality. Secondly, we have Sarah Godar from the EU Tax Observatory, and the DIW, so we're in Paris and Berlin here, and she has done a lot of work on offshore wealth, and she'll be presenting to us here some of the numbers to really get a better grip on how big is the problem actually of financialization that goes offshore and hence becomes more difficult for national tax revenue to actually discover and try to get revenue from. And then finally we move to the Global South with Giovanni Ochialli, who's a development economist at the International Center for Tax and Development at Sussex. He works with a lot of revenue agencies, especially in sub-Saharan Africa, on developing their capabilities for raising revenue, not only but particularly from the rich. And he will be telling us more about what these revenue agencies actually need. And I think all of them may show us some data, give us some answers that may actually be surprising, and I hope will really feed our research. So they'll have exactly 15 minutes each, and after that the floor will be open to you for questions and discussion. Thank you.
Okay, then thanks very much for that kind introduction, and thanks also to the organizers for inviting me and giving me the opportunity to present what is really ongoing work in progress still, and which is still sort of a set of, well, analysis, one might say, that I'm doing together, not by myself, but with a doctoral student, Timo Wiesner, who isn't here with me today, but who nevertheless has to be credited for this work. And this is still work in progress, so any kinds of suggestions and ideas are very much welcome. And as Marlies already alluded to, I'm not exactly talking about the super rich or taxation, so why might that be interesting at all in a panel on taxing the ultra-rich? So investigating sort of the popular support or attitudes or normative tolerance for wealth inequality in a cross-national perspective tells us something about the larger political climate within which sort of we think about attempts to tax the rich, and also tells us something about sort of the demand side, if you will, hopefully, about such endeavors. So the starting point is what may be rather familiar to you. We have high and rising levels of wealth inequality that we observe over many OECD countries during the last years. And wealth also has emerged as a central dimension of inequality and stratification in contemporary societies. However, we don't know very much about how the public perceives and views these wealth disparities, and we also don't know very much about how this varies across nations. And here you see public attitudes towards wealth inequality in Europe, measured by the European Social Survey 2019, on a scale of -4 to +4, how fair or unfair people find wealth inequality. And that's on the on the y-axis, and on the x-axis you see two measures of objective inequality. That's the top 10% wealth share on the left part of that graph, and the Gini coefficients on the other hand side. And as you might see, there is no straightforward relation between actual levels of inequality and popular legitimacy of wealth inequality or popular concern with wealth inequality. And even if we take out Slovakia, which is sort of an outlier, we have a somewhat steeper line here, but it's still a rather more moderate correlation. So the question for my talk is, how can we understand then, given the absence of social structural sort of impact on popular attitudes, how can we understand the cross-national variation that there nevertheless is? I mean, you see, for instance, a country of the Czech Republic, Bulgaria, and Lithuania, where sort of, on average, wealth inequality is largely considered fair, and you have countries like Hungary, for instance, Cyprus or Croatia, where we have larger sections of the population who find it unfair. So how can we understand this cross-national variation if social structure and actual inequality isn't doing sort of here much of the heavy lifting, so to speak? And the overall argument that I'm trying to make in that talk is that the legitimacy of wealth inequality is to some extent shaped by cultural and by institutional differences between countries. And the thesis that we propose in our paper is, or the thesis that we sort of want to, well, not test in a strict way, but that's sort of our guiding question, is, might there actually also be a greater normative tolerance for wealth inequality in societies that are more collectively oriented, both in an institutional and in a cultural sense? So the two research questions that we pursue in that piece is, first, how does the legitimacy of wealth inequality relate to broader ideas of social justice? And are there distinct configurations of specific moral economies, as we call them, of wealth in different types of countries? And if we find such specific moral economies of wealth, how do these then relate to the varying institutional and economic contexts that shape the significance of private wealth? That means how important wealth is for your life chances within their nations. So the conceptual framework we start from builds on two strands of literature. The first is a stream of literature that can be called the moral economy perspective. And the overarching idea here is that people's economic behavior and attitudes is not directed entirely by self-interest alone, but it's rather embedded in broader notions of social justice and fairness. And these notions of social justice and fairness and what's considered appropriate also color and impact what people find fair with regard to wealth inequality and what kinds of inequality they're willing to accept and what kinds of inequalities they're criticizing. And we know from prior research that across countries we find majority levels of support for the principle of meritocracy, but rather varying levels of support for principles of equality, need, or entitlement. The other half of our conceptual framework builds on an institutionalist literature where we argue or follow recent additions to the literature, actually, or contributions to the literature that argue for the relevance of broader institutional configurations that impact how relevant private wealth becomes for one's life chances. So we see, for instance, in cross-national analysis of wealth inequality that what's often the egalitarian poster children in much of the stratification and welfare state literature, which are the Scandinavian nations, they actually have pretty high levels of wealth inequality. And that's sort of a puzzling thing, but if you think about it more thoroughly, they might well be able to tolerate much higher levels of wealth inequality because there is a much higher level of collective provision for a large array of goods and social services within these societies that sort of make you and your life chances as a household or an individual much less dependent on private accumulation, for instance, with regard to social security, housing, education, or health. So if you have a functioning healthcare system, you don't need to save up a lot of money in case you have a major surgery or something similar as in some other industrialized nations. So that would then need us to expect or to ask whether we might be observing greater normative tolerance for wealth inequality in these more collectively oriented societies. So to sort of, sum that up graphically, we start out from the observation that social structural conditions, and we not only looked at wealth inequality that I showed you on the first slide, but also at income inequality, which sort of can generate wealth and wealth inequality, at wealth to income ratios, which is sort of the amount of wealth that exists in relation to sort of the overall state of the economy, at home ownership rates and economic prosperity in general. And all these are only weakly correlated with fairness assessments of wealth inequality. So instead, we also take into account the institutional characteristics, especially welfare state provision and other forms of government social provisions, and ask how fairness evaluations of wealth inequality that you see here in the middle are embedded within sort of on the institutional, social, structural side, different inequality regimes that exist across countries. And on the other hand side, in different moral economies, which are sort of the sociocultural and normative embeddings of wealth inequality and the different kind of support for social justice principles that we find. We use data from 27 European countries from the European Social Survey, and as we saw no strict correlation between these attitudinal variables and social structural indicators, we sort of proceed with an explorative procedure with a hierarchical cluster analysis of these attitudinal variables and the social structural indicators that I just explained to you. I will skip over these in the interest of time. And I will describe first the distinct clusters that can be found within the data when we combine sort of these attitudinal and social structural and institutional indicators, and then describe the clusters a little bit more in detail with line plots. So all very simple descriptive analyses. So here you see a dendrogram. That's sort of the outcome of a cluster analysis, and it basically groups countries together that are internally similar to each other and sort of distinct from one another. And if you look at the level of dissimilarity, which is at the bottom here of the x-axis, the higher you get on that axis, the less clusters you can observe. So if you start right on the left side, you have one cluster consisting of Germany and Austria, who are of course obviously very similar. And if you go over 100 or between 50 and 100, there's then only 2 clusters of countries. And if we look at fit indices to indicate to us which is sort of not an optimal, but a sort of substantially meaningful agglomeration or clustering of countries, we can observe 3 to 4 clusters. The first cluster of countries is what we call the critical cluster of countries, which consists of Southern European and Southeastern European nations. Italy, Portugal, Spain, and others are in that yellow cluster. Then we also have a group of Eastern European countries which are very uncritical, very affirmative. And these are the Slovak Republic, Czechia, and the others that you see here. And then we have a large group of continental European nations who are very similar to one another. So how do these look like? First, with regard to the critical cluster, we see, and these are, the Southern European, Southeastern European ones, they have very low levels of normative tolerance for wealth inequality, so they're very critical. And on the ideational level, this is embedded within above average support for the principle of equality and below average support for the principle of entitlement. In terms of welfare state activity and public provision, they're rather average. They have some below average spending for education and health. They're rather not very affluent countries, so GDP is well below average, and they have some degree of home ownership. On the other hand side, this is sort of the most affirmative cluster. These are also a group of Eastern European countries where sort of this high legitimacy of wealth inequality is embedded in a very strong support for the principle of entitlement, so people who have more should be allowed to keep what they have, and a very low support for the principle of need. Welfare state activity isn't very highly developed, and we also have rather modest economic conditions. We have a high level of income inequality, but paired with a high level of home ownership. And this has, to some extent, probably to do with privatization of housing after the communist transition. And the last cluster is the sort of average cluster. These are the continental European nations. We have average levels of support or average levels of legitimacy, which is embedded in above average support for the principle of need. Specifically, we have rather developed welfare states. We have a high level of economic prosperity, so GDP is well above average, but we have rather low levels of home ownership. So, to sum up, now there's a comparison, but I mean that's probably more confusing. We wanted to see sort of how the legitimacy of wealth inequality is embedded within broader notions of social justice and fairness on the one hand side, and whether institutional context can sort of give us hints as to the normative tolerance for wealth disparities, and there's not necessarily greater tolerance for wealth inequality within countries with greater collective provisions, but we rather find a clustering into a critical, an uncritical, and a moderately critical cluster that I summarized here. So it's rather an interplay of normative, of institutional, and of social structural conditions that shapes the degree to which wealth inequality is seen as a normative problem. So, thank you very much.
Yeah, thank you for giving me the opportunity to speak about the taxation of what was the term, ultra-rich or super-rich or billionaires? I think we know what we want to talk about, but I do a bit of mix of different research projects that I've been engaged in, talking about offshore financial wealth, increasing international financial transparency, and taxation of capital income. And I hope we will see how this relates to taxation of the ultra-rich in a bit. So, so the first point I want to make is when we talk about taxation of the ultra-rich, we need to talk about taxation of capital income, because the ultra-rich earn the most important share of the income is derived from capital, and this and there is increasing evidence that the effective tax rates paid on capital income tend to be lower than effective tax rate paid on wage income, and this exacerbates inequalities. And when we think about taxation of capital income, we always have to distinguish a bit the passive capital incomes or returns to financial assets, which are usually part, or more typically part of the personal income tax, and thus subject to the progressive tax systems, at least in Western Europe, and business incomes, which are first of all subject to corporate tax, and only become or are only part of personal income tax once the profits of the businesses are distributed to the shareholder of the business. And luckily in the recent or last 2 decades we have seen important progress to improve or facilitate taxation of capital incomes. So one is the automatic exchange of bank information under the Common Reporting Standard, which was agreed in 2013 among the G20. And nowadays more than 100 countries participate in this information exchange. And this should improve or facilitate taxation of returns to financial assets under the personal income tax. And then we have seen the global minimum tax for multinational corporations being implemented, which should, in principle, strengthen the corporate income tax. And as we know, like the richest are usually also have a high correlation of being the owners of those corporations. So in principle, this should also increase the effective tax burden on the ultra-rich. However, the global minimum tax on multinational corporations doesn't really live up to what we hoped for in the beginning, so it's very low, it has a lot of loopholes. So maybe we have to think about other ways of taxing corporate income of the ultra-rich, and I will get to this in the end of the presentation. So, I will draw on insights from 3 different papers, so it will be a fast ride. I hope I can do it in 15 minutes. One is on offshore financial wealth, and one is on the automatic exchange of information under the Common Reporting Standard. And then I will just, in the end, pitch the idea of the director of the EU Tax Observatory on the global minimum tax for billionaires. Okay, let's start with offshore financial wealth. So offshore financial wealth are financial assets owned by households and held in banks outside of their country of residence. Yeah, so Switzerland is usually taken as a typical example, which used to be the epicenter of foreign custodian banking. And in earlier research, Gabriel Zuckman estimated that households store financial assets worth 10% of global GDP offshore in 2006-2007. And at the time, research suggested that in the absence of third-party reporting, when you rely only on self-reporting, and in this case, as it was, this wealth was held outside of your country of residence, there was no system of third-party reporting put in place. So one could assume that about 90 to 95% of this offshore wealth went unreported to tax authorities at the time. But since then, as I said, automatic exchange of information was implemented and has increased compliance, or should have increased compliance significantly. So what we do in the first paper is that we construct or we update these estimates of offshore wealth and create time series of global household offshore wealth and analyze the location and ownership of offshore wealth over time. So this is one of the key figures of the paper, where you see that we have, first I would like to draw your attention to the purple line that starts in 2001, because this is the main estimate of the paper, which we derive from gaps in international financial statistics. So systematically over the years, we find that in the international portfolio statistics of the International Monetary Fund, we find systematically more liabilities than assets, meaning that a certain share of assets remains unreported in global financial statistics. And based on this, we estimate the total value of wealth held in foreign custodian banks outside of one's country of residence, because we believe that this is the origin of this reporting gap. And based on an alternative methodology, we have also tried to go back to the 1980s and trying to see how this gap developed in earlier decades. And the main takeaway from this graph is that our findings suggest that offshore wealth has increased sharply in the 1980s and 1990s, from about 2% of GDP to around 10% in the end of the 90s. And then we find more or less a stabilization around 11% of GDP since the early 2000s. And while until the automatic exchange of information, one could assume that tax evasion almost always occurred as a byproduct, we wouldn't say that it was necessarily the primary reason to hold wealth offshore. Yeah, so the fact that the offshore financial wealth doesn't decline after the implementation of the automatic exchange of information maybe shows us or suggests that tax evasion is not the primary reason, but there may be other reasons to hold wealth offshore. That is, you can only get access to certain investment funds through certain banks in certain financial centers, or you might want to circumvent other regulations such as foreign exchange controls or bankruptcy law, or you want to hide income from your spouse. There are many different reasons, so it could also just be a general phenomenon of capital flight that you observe here. The black dots actually show the share of offshore wealth held in Switzerland, which has increased also until about 2007, and then stagnated or even decreased as a share of the total. So we find that Switzerland, once the epicenter of foreign custodian or wealth management on behalf of non-residents, has lost a little bit in importance. And we find that Asian financial centers, Hong Kong and Singapore, but also the UK, have increased in importance relatively. We also analyze or try to estimate who owns offshore wealth. So we do country estimates, but here I just wanted to draw your attention to the fact that the share of offshore wealth owned by residents of middle and low income countries has increased somewhat, from about 20 to 30% over the last 2 decades, but is still predominantly owned by residents of the rich countries. Okay, so as I said, the G20 claims that let's say the OECD has claimed that the problem of offshore financial wealth has kind of been resolved through the automatic exchange of information, and has also put forward a number that is, in 2022, the participating countries have exchanged information about, here it is, covering assets of almost 12 trillion euro that was exchanged automatically in 2022. And this is very close to our offshore financial wealth estimate of around 11 trillion US dollar. So one could, if we were very optimistic, we could also agree, yeah, the problem is solved, but we think that these two numbers are not very comparable. So in another research project, we gathered Oh, okay. we gathered statistics from different countries on the financial wealth which had of their residents, which has been reported to them through the automatic exchange of information. And countries are very reluctant to publish those numbers, and we were very lucky that at least 16 countries got back to us with global figures, and only 5 provided the sub-aggregates that we needed to actually compare the numbers to offshore financial wealth. Yeah, so here you see the countries that provided global figures, and you see in this figure we compare the CRS reported foreign wealth to our offshore financial wealth estimate, and you find that most wealth that is reported or in most countries, the wealth reported through the automatic exchange of information looks higher than our offshore financial wealth estimates. However, we would say that only a share of this is actually comparable, and that is because this CRS reported wealth also includes wealth of active companies and also financial wealth held in neighbor countries, while we say offshore financial wealth refers only to wealth held in financial centers, yeah, which are well known for managing financial assets on behalf of non-residents. So here, when we look at the 5 countries that provide a better breakdown, I would like to draw your attention to the orange bars. Dark orange bars, which actually represent the share of CRS reported information that refers to financial accounts held by households in financial centers. And this may be directly or indirectly through passive entities, yeah, the so-called letterbox companies. We see that in most countries, the CRS reported wealth is still below our offshore financial wealth estimates. But on average, we would say that the information exchanged under the CRS covers up to 70% of our offshore financial wealth estimates. And when you compare this to what I said initially from 2006 or 2007, the values that we had, where we said under-report or self-reporting was only close to 5 or maybe 10%, a value of 70% would be a very big step forward. There are some problems also related to, but you can read more in our report about the CRS. I will not go into details now. I just want to say that the coverage and the data quality looks better than what many observers had feared initially. Okay, so the good news is the scope for taxing passive capital incomes seems to have increased thanks to the automatic exchange of information. But when we talk about billionaires or the ultra-rich, we know that actually most of their wealth is in their businesses, right? They are the shareholders of businesses. And this is the last slide. And the corporate tax rate in the OECD and also in the EU has actually decreased over the last 3 decades. Yeah? So it has been on a continuous decline, meaning that the owners or shareholders of businesses have benefited from this decline in corporate tax, and in principle, they should distribute when they distribute the profits to the shareholders, they should be taxed again under the personal income tax. But the problem is that many of the ultra-rich are so rich they don't even need to distribute the profits to themselves. They just store them in the business. Yeah, so that means that only tax that they pay on these profits is the corporate tax, and they will not ever be subject to the progressive personal income tax scheme. So that's why Gabriel Zuckman, the director of the EU Tax Observatory, has proposed a global minimum tax on billionaires or centimillionaires, you can, depending where you want to draw the threshold, and it should ensure that personal income tax payments amount to at least 2% of net wealth. So in a sense, it is a measure to restore the progressivity of the personal income tax. It's not a proper wealth tax, yeah, because if you pay enough personal income tax, no top-up tax will be due. But if you fail to pay personal income tax in relation to your whole economic income, up to this threshold, then you might be subject to a top-up tax. Yeah. Can I wrap up? Last slide, yeah. So, yeah. So, to conclude, globally, households still hold financial assets worth US $11 trillion offshore, but the international financial transparency has increased a lot, so that the CRS might cover as much as 70% of those financial assets, so that taxation of passive capital incomes should get easier. Yeah. However, the ultra-rich can still avoid progressive personal income tax on their business incomes, and the global minimum tax on billionaires could be a measure to reduce this disbalance somehow. Thank you.
Thank you very much for having me here. It's a pleasure. Let me start by quickly saying a couple of things about what I'll be presenting about today. What I'm presenting about is work that I carried out together with a lot of other colleagues and colleagues before I even joined at the International Center for Tax and Development across about 10 different sub-Saharan African countries. Throughout the presentation, I will be talking about lower income countries. This is a term that covers both low income countries and low middle income countries. A lot of what I cover actually originates from Africa, but we do not have many reason to believe it is substantially different in other parts of the world. Finally, I mostly work with civil servants and tax officers in revenue authorities. So a lot of what we cover is very much in the realm of what is practically feasible and politically feasible. And our approach is something that we define as bold about the basics. So like fix the stuff that should be working first and then think about fancy things afterwards. So why should we think that taxing net worth individuals in low income countries should be a priority, right? Like, a lot of people when think about low income country, they don't think about very unequal places. But this is actually a very wrong image. Low income countries are as wealth and equal as high-income countries are. So in high-income countries, the top 10% of the population owns about 18 times the wealth of the bottom 50% of the population. In low-income countries, the figure is about 15 times, so not that far away. Okay, when we think about wealth, the difference between high-income countries and low-income countries is very small. When we think about income, low-income countries are actually more unequal than high-income countries. Okay, the top 10% of the population in high-income countries own about 2.3 times the amount of income than the bottom 50%. In low-income countries, that figure goes to 3 times. You might have noted I said might around. Okay, they might own this amount of money, and the reason why I say that is that we don't really know. Okay, like we use a survey that are run to measure the living standard of the population to derive the distribution of income and wealth. In high-income country, we can see that from tax data, but in a lot of low-income country, the data is just simply not there. So when we think about the consequence of this inequality, they are great. Right, we know there's a lot of scholarly work that demonstrates that the more unequal a society is, the lower intergenerational mobility there is, the lower people want to invest in their education, the lower the growth is. And this is a problem everywhere, but is even more of a problem in context in which governments are trying to uplift the vast majority of their population from absolute poverty, when there's a lot of need to invest in the development of health system, education system, and you're trying to do all of these while subjected to massive level of debt and to growing threat from the climate crisis. So, in this context, it is clear that reducing inequality has a lot of value, so much value that there is a sustainable development goal that's been dedicated to it, and a sustainable development goal that we are vastly missing. Okay, so there's almost no chance that we will be able to reduce inequality amongst countries or within countries by 2030 if we continue with business as usual. The situation is worsening even more over the last couple of years as fewer and fewer countries will dedicate part of their tax revenue as development aid. Development aid is decreasing, and that will put even more pressures on low-income country government to find alternative way to fund development need. Now, this very nicely leads me to talk about revenue, because revenue is already the main source of development finance in most low-income countries. Most people think that aid plays a huge role. Since the early 2000s, domestic tax revenue has become the main source of government finance across most low-income countries. But the amount of revenue that low-income countries collect is substantially lower than the amount of revenue that the OECD country collect. The OECD country, on average, raise 35% of GDP as revenue. In low-income country, that average is 13%. So it's a lot less. But it's not just a lot less, it looks very different. So this graph shows us, in proportion to the dimension of the economy, how much tax revenue originates from different taxes. If we look at corporate income tax or VAT, so broad-based taxes, they raise pretty much the same amount of revenue from these taxes as high-income countries do. If we look about personal income tax, high-income countries raise, in proportion to the size of their economy, 3 times as much revenue from personal income, 7 times as much revenue from property tax. And these are the tax bases that matter the most for wealthy individuals. They own assets. They derive their income from a variety of different capital gains. When they sell assets, they rent flat. These taxes are by far the taxes that perform the worst across low-income countries. So how to make these countries' tax system more progressive, how to ensure that the taxes that high net worth individuals should be paying the most perform better is a very important question. Now, if we think about some of the things that we just heard about the global wealth tax and how does it look like to think about taxing high net worth individuals in high income countries, we are talking about wealth. We want to tax the retained earnings of corporations, the dividends that have not been distributed. We want to tax the trusts. We want to tax the inheritance. And the reason why we want to tax all of these things is that, notwithstanding tax avoidance, by and large, individuals are complying with their income tax obligation. The income tax may be too low, but high net worth individuals are paying it. They just don't derive that much income anymore. And revenue authorities have a lot of capacity to exchange data across the world, to tap into a lot of information here and there. And that has led to this proposition of, let's start taxing their wealth, because this is the thing we are not taxing at the moment, and this is where the money is. Now, there's about 3,000 billionaires in the world and 28,000 centimillionaires. Okay, so this is, for the proposal we've heard at the end of the last presentation, this is the people we are trying to tax. Okay, so I fully support the idea of implementing this type of tax, which is presented as a starting point, even by the proposer. Now, let's imagine how that would work in Africa. Okay, like Africa has about 1.5 billion inhabitants, 20% of the world population. They have 21 billionaires and 342 centimillionaires. That's 0.5% of the population of billionaires and centimillionaires, which already gives us an idea of how wealth and income inequality have their roots in colonial and post-colonial structures, right? Like we look at the place where a lot of the world lives, but very few rich people actually live. Now, does it make sense to start thinking about taxing the wealth of this individual? What do we know about how many individuals are paying income taxes even? Like 5% of the population pay income taxes, right? We started thinking about taxing wealth in income countries because compliance with income taxes was already there. Now, in a lot of low-income countries, compliance with income taxes is extremely low. And revenue authorities are not really well capacitated. The average tax officer of a revenue authority in a low-income country manages 10 times as many taxpayers as the tax officer of a high-income country. So how do low-income countries currently attempt to tax high net worth individuals? Well, the starting point is the legal framework, right? We have to go and see what does the legislation of this country say, and if we look at the legal framework, all the taxes that we have, here in Hungary or in Italy where I come from or in England where I work, they're all there. Okay, like the tax system on paper looks exactly the same in the vast majority of low-income countries. There's taxes of self-employment. If you're a lawyer or a dentist or an engineer, you tax the rental income of landlords, you tax the dividends of shareholders, you tax capital gains. So, a lot of similarities when we look at the legal framework. Wealth is a slightly different thing. We do have some experience of wealth taxation in Europe and in Latin America. The only real tax that there is in low-income countries for wealth is on property. Now, what type of obstacles do these revenue authority face when they try to tax high net worth individual? Well, the first one is identifying them, deciding who a high net worth individual even is. We were talking about taxing billionaires, right? In Uganda, where this was developed in conjunction with the revenue authority, they decided that if you have more than $140,000 per year, you're a high net worth individual. Well, that makes sense because, the average income in Uganda is $1,000 per year. In Nigeria, it actually changed from state to state, and it starts from figures as low as $60,000 per year, which again, for an income of $1,600 as average, makes a lot of sense. So who is a very rich individual very much depends on the context of the country. And we can see that compliance is extremely low because when we started looking into the data of tax administration, then we could see that, in 2015 in Uganda, only one of the top 70 government officials ever paid any tax. Okay, only 12 of the top 60 lawyers ever paid any tax. When in Sierra Leone we started looking at landlords, okay, of the top quintile of landlords in the country, only 35% had even registered for taxes at all, let alone paying them. Okay, the revenue authority had no idea who these individuals were. So, all of this different structure of avoidance and offshore wealth we were hearing about matter a lot less in this context because people are simply evading, right? So there's no reason to start doing very fancy things if nobody knows who you are or where you're keeping your money. That doesn't mean that African countries aren't trying their very hardest to actually tap into offshore financial wealth too. Since 2014, when we started having exchange of information, we now have 20 countries across Africa that are exchanging information. And since last year, we have more requests of information originating from the continent, so African countries asking to other countries around the world to receive information about the tax affairs of their citizens, then there are other countries asking for this information to African countries. There's a lot of money to be made. In 2023 alone, $2.2 billion of unpaid revenue were identified. Now, the problem is that once you start looking into how many countries are actually making use of this, the figures are really low. Of the 20 countries that have actually started exchanging information, only 11 have ever sent more than 20 information requests. And only 5 countries in the continent could use the type of data that we were hearing about that is exchanged automatically. So is this a priority? Is this the thing that African countries should be focusing on? Very much depends on whether or not you have a domestic tax system that's working at the start. Now, we are here to talk about the effect of high concentration of wealth on democracy. So a couple of things about the politics we should really be saying. Now, the first things to say is that it is straight on impossible to try and tax high net worth individuals if there isn't at least some support from governments. And I've worked with 4 different African countries, and I collaborate with the institution that are working with another 8. It is extremely hard to even start this conversation in practice, okay? And this is not because, you know, they'll kidnap you or anything, just because there's so many easy ways to stop this work from happening. You can stop data from being shared. You can stop investing in the capacity of your revenue authority to carry out the type of investigation required to identify this individual. Or you can just have a minister calling a commissioner general, the head of a revenue authority, telling them to stop doing the work they're doing. And all of these things have happened, okay, in projects I was involved in. This doesn't mean that there isn't some public support, okay? We've tried looking into how much public support there is for these kind of things. You know, in Sierra Leone, during COVID, we had, you know, taxes on the rich being the second most favorable way to pay for public expenditure during COVID. In a project connected with Zakat in Pakistan recently, we did find that, again, there is, you know, somehow 50% of the population that does support increase in personal income tax rate. But overall, the support is quite low because states are not very functional, right? If you live in a context in which the state doesn't do much for you, as we were hearing before, then you don't really believe that tax revenue will do much. And, you know, to conclude, and I hope that there's going to be, you know, a lively conversation, I think that when we think about the taxation of high net worth individual in low-income country, we are starting from a completely different point, right? We are starting from a point where evasion matters a lot more than avoidance, when the resources of revenue authorities are extremely low, and when the data available to carry out many of the, you know, in-depth investigation we've heard before is like simply not there. So the thing that is really important is to start doing what you can with the data that you already have. And change is possible. I can provide you with a few examples of countries that, you know, really collected quite a bit of money in a very short amount of time. This type of conversation we are having here matters in pushing the conversation away from taxing the informal sector, taxing all of the, you know, tomato seller along the street, and to shift the narrative towards, you know, really going where the money is, which is in the pocket of the many wealthy individuals that also exist in low-income countries. So thank you very much. And this was it from me.
A great big thank you to the panelists. You've heard a tremendous amount of information from this cross-regional, cross-disciplinary panel. I hope that you found that there were some surprises, as I promised. I think there's also some tension between the findings and recommendations of the different panelists, which is great. I'm going to ask each of the panelists one short question of my own, and also give them an opportunity if they feel the need to respond to each other, and then I'll get to you, the audience. So for Patrick, I wanted to ask you, you've done survey research where you're asking about the legitimacy both of wealth inequality and of income inequality. And I wondered whether the results are any different, i.e. does the public even understand the difference between wealth and income inequality? My question, I'll do all three, and you can think about the answer. My question for Sarah would be, you suggested, and I've read it in the report as well, that tax evasion may not be the primary reason for offshore wealth. And I've always been a bit skeptical of that. I think, you know, how many mistresses are there that kind of require money to be hidden away from wives, or is it all criminal money? Just because we don't see it falling off as soon as there is automatic exchange of information doesn't necessarily mean, I think, that it wasn't always about tax avoidance. I think just because information is now shared doesn't mean that the revenues can immediately start clawing it back. So yeah, I wondered if it's not tax evasion, then what else? And then for Giovanni, I think this is a really important question. I'm sure you get a lot of pushback, and I'm going to play this devil's advocate, from wealthy but not necessarily super wealthy people in African countries and Hungarians saying, my country is so corrupt, why should I pay taxes? It's going to end up in the pockets of politicians. So I wonder what you say to that argument. Let's start with Patrick.
Yeah, can you hear me? Okay, thanks. Well, to some extent, I think we don't have really much data on how people perceive wealth inequality, so it's difficult to compare sort of perceptions of income inequality, which we have some good ideas and good studies on, to perceptions of wealth inequality. I think what's different is that sort of wealth consists of rather different components, and at least the surveys and the questions I know haven't started unpacking these different components. So when you ask people in the abstract, so what kinds of levels of wealth they would find acceptable, or when they would consider people as rich, you would get probably very different answers than when you break it down into different categories, and when also categories are mentioned that matter to what we would consider as non-wealthy citizens, for instance, homeowners. So home ownership is the largest component for sort of 99% of the wealth, or the most relevant component for 99% of the wealth distribution. And when you look at sort of the debate about inheritance tax and why people are so reluctant to, or at least Germans are so reluctant to tax inheritance, then that often revolves around housing and family housing, and the house of the grandmother or aunt or whoever, and which also has been subject to asset price inflation. So suddenly people become very wealthy that wouldn't ever have dreamed of seeing themselves as wealthy. So I think that what we need to do actually would be to sort of unpack and to look at sort of these different components and how they think different components should factor in that sort of when evaluating people as rich, and when thinking about what components actually should be subject to what kind of taxation. So.
Yes, I will answer to the question of, is offshore wealth tax evasion? I mean, maybe I was a bit too general, saying tax evasion wasn't the primary reason. I think the literature, there's a very good book by a sociologist, Brooke Harrington, I think. She writes about, it's called Capital Without Borders, and she writes about the wealth management industry and the clients of the wealth management industry. So apparently there is an industry around managing your assets, but the fees for making use of this service are so high that most of us probably wouldn't be able to pay them. So it's a different world of people, and they get access to certain investment funds also through certain banks in certain financial centers. So we all know the city of London is very specialized in this. Switzerland has been very specialized in this, or the Swiss banking industry. There is also this, for example, getting access to the Chinese economy. That was very regulated in the past. So you had, if you wanted to invest in China, you had to go through some banks in Hong Kong or Singapore in the past. So there are some reasons for holding assets offshore. What I wanted to say, or what I wanted to stress, that in the past, tax evasion almost always occurred as a byproduct, if it was intended or not intended. And now we see that despite this increased transparency, we observe some repatriation of funds to the domestic banks, but it's not a major phenomenon. So what we concluded is that those structures have been put in place. People have their wealth managed in London, Hong Kong, and Zurich, and they will not just bring the money back because of an increased transparency, because they still make use of this wealth management industry in those financial centers. Yeah.
Check. Okay, cool. Corruptions and taxes ending up in the pocket of politicians. I mean, this is definitely an argument. I think it's an argument that is especially pernicious when coming from minority individuals, because in a lot of the countries where I work, these individuals are either politicians themselves or they are funding the campaigns of the politicians. So, you know, it is a bit of a perverse thing. You know, like, you know, money, wealth, always gives you political power. How you use that political power is then up to you. If you have all of that wealth, well, then you might be supporting the campaign of less corrupted politicians, and that could be a good starting point. The second thing is that, you know, it is a very unethical argument, because no one else has the choice. You know, a lot of everyone who is in a salaried job has their tax withheld at source. They cannot decide not to pay taxes. You know, you have the luxury to decide not to pay taxes if you derive your income from very specific sources of very specific activity. You're renting out flats, or, you know, you're selling and buying things. Everyone else just buys things and pay consumption taxes, or work for a company and has their taxes withheld at source. So, you know, like, what gives you the power of making that decision where everyone else does not have that power? And then the final thing is that they can afford to make that argument because they do not rely on public services. Like, a lot of corruption exists because public services are very poor, and therefore politicians hold rental power because they can withhold access to things, and then they ask money in exchange for that. If public services worked, then the capacity of asking money to access public services would decrease, and public services to a great extent don't work because there isn't enough tax. So it's a very vicious argument that goes around and around on itself a lot of times.
Okay, thank you. I just wanted to... let's go to the audience. I saw already the gentleman in the black T-shirt there.
For a lot of empirical material and some optimism. Giovanni, I was wondering, when you said high-income countries receive a lot more from personal income tax and property tax, and therefore tax the wealthy more, I doubt, right? Because I don't think that higher income tax share and higher property tax share is actually the people we're talking about, the billionaires and the super rich. And I actually have, from everything I know, it just, even in the rich countries, it has not worked empirically, historically. Right? Sweden abandoned the wealth tax. Germany abandoned the wealth tax because it was deemed unconstitutional. France abandoned the wealth tax. It never captured much. Spain reinstituted the wealth tax. It does not generate a ton of revenue. So the historical examples are complicated. It is not encouraging. I think for me, the idea to tax volatile wealth, because ultimately we're talking about volatile wealth, it's assets whose value changes every day. So even the proposal to top up the income tax to 2% based on what? A share that fluctuates daily. If that's going to take place, I think most billionaires would take their companies private. They just would. Elon Musk has only one company that is public because he prefers to have them private. So I think that whole approach to tax wealth, while it is in assets, I don't see that working. And for me, the energies should be on inheritance, that, like several other activists and economists have proposed. If you want to tax wealth, also from an ethical perspective, it's the transmission. That's where it's easy, because the inheritors want a share. It needs to be legalized, and that's also where it's ethical, because you transmit something where somebody gets something without having generated anything, right? So I'm wondering whether the energy should not go more in this direction.
Thank you so much for a very interesting discussion. I have a question to Patrick, actually. I really It was interesting what you were presenting, but then from among the structural factors, I really missed anything about illegitimacy of wealth or a component of autocratic regimes or something along the lines of what's the perception of the population, how that wealth was accumulated. And it was an interesting category, the one which had Poland, Hungary, Croatia, Italy together. I mean, Spain was a little bit out of that, but the rest, to me, they really belong together in terms of corruption, autocratic wealth accumulation, and so on. So I wonder if you were thinking to integrate this among your structural components.
Okay, so I do research on Ukrainian and Russian businesses, and in those countries there have been successful taxation reforms, and they were successful because they were supported by super rich themselves, who thought that it's better to pay taxes officially than to pay bribes unofficially, so that it's much cheaper. Taking these experiences into the account, the real question would be not how to tax the super rich, but how to make them willing to pay taxes. So do you have any answers how to make super rich willing to pay taxes?
Okay, we'll take them in the order of the panel, and you can answer whatever you like and leave unanswered what is impossible.
Thank you. Thanks also, I mean, that's a very good hint on the sort of perceived corruption or the process of wealth accumulation. Unfortunately, we rely on secondary survey data, and we would have to sift through the questionnaire again to see whether there's any sort of something like a corruption or trust in government, something like that one could include. Maybe that changes something. That's a good idea. With regard to the doubt on the net wealth tax, I'm torn back and forth actually with regard to the arguments. Historically, the interesting thing is that when the income tax was introduced, the argument was the same for the income tax, because income was seen without welfare state provisions. For instance, in the case of sickness or retirement, income was seen as so volatile that the necessary, or not necessary, the natural thing to tax was wealth, because wealth was seen as much more durable than income that was subject to all those fluctuations. So the arguments sort of shift with historical situations and institutional conditions in a way. And now that doesn't mean that the net wealth tax would solve, or I don't think that the net wealth tax would solve all problems that of wealth inequality that we have. And also I think even if it doesn't do much in terms of redistribution, the question I think is it a way to institute an institutional architecture in society that enables people to be less forced to accumulate privately, or that sort of, relieves them from the necessity to accumulate privately. I think normatively, that's, for me at least, the way I found for the moment to get my head around it.
Yes, I mean, I'm of course less pessimistic on the possibility to tax wealth. I think in a way, I mean, in economic terms, you can always transform a capital income tax into a wealth tax or a notional income tax. That if you have a certain wealth, we assume that you earn at least 3% annual return on that wealth. And based on that, we can say you should at least pay around 30% or whatever is the top marginal tax rate in the economy on this notional income that you would be able to earn with your corporate or financial wealth that you own. And I think the difference between the inheritance, I mean, the fact that inheritance taxes exist shows that the wealth tax can also exist. Because what do you do when to charge inheritance tax? You have to value the businesses that the family owns or that get inherited. And there is a long-standing experience of tax auditors of doing that. So even if the company is not at the stock market, even though probably like many big corporations have a strong interest of being at the stock market, so I don't think it's so easy like they all go private. But even if they go private, there is a long-standing experience of valuing companies. And then, of course, you will have some conflict around determining the value. Yeah, is it 1 billion? Is it 800 million? But even if you agree, okay, actually it's just 700 billion and not 700 million and not 1 billion, charging a tax on that is already better than not taxing at all. So I think we shouldn't be so pessimistic on it, and I also don't think we need to convince the billionaires to voluntarily pay tax. I think we should just convince the population that there is an interest or a benefit in making the ultra-rich contribute more to the common good, to the public infrastructure that we can all benefit from, and then implement it. And as you said, mentioned the German example of the wealth tax, there are some estimates from the DIW also that say that estimate that the administrative cost of the German wealth tax was somehow 4 to 8%. So, I mean, it's not nothing, but it also doesn't mean that all the additional revenue that you generate will be depleted just by paying or hiring additional tax auditors. It's a reasonable share of the additional revenue that you will spend on administration.
Okay, so I'd like to touch on a few different things. First, the graph. Sure, I agree that in high-income countries, property taxes and personal income tax does not account for any significant share of what the ultra-rich pays. I think that what the graph wanted to show is that if you look at broad-based consumption taxes such as VAT or proportional taxes such as CAT, then proportional to the size of the economy, low-income countries are doing great. Where they are not doing great is in progressive taxes, right? Personal income tax is progressive everywhere, and property taxes have some element of progressivity in a variety of countries. So even though on paper, the tax system of progressive countries is progressive. Once you actually look at how enforcement makes the tax system work, they aren't progressive at all, because the progressive taxes are the ones that perform the worst, and therefore, there is scope to focus on improving the performance of progressive taxes. Also, a lot of the work that we do with our colleagues from revenue administration focuses nowhere near the level of a millionaire. Like $100,000 is pretty much the average across the countries we worked in, where someone is considered to be a high net worth individual. And that makes a lot of sense, given that a lot of the countries we work in have as per capita income about $1,000. Like once you earn 100 times the average per capita income, then it makes sense. And at that level, property taxes and personal income tax matters a lot more. And because of reporting personal income tax there included withholding taxes on dividend and rent, capital gains taxes, all of that is subsumed under personal income tax for international reporting. I actually have something on the democracy thing, because that's something that I always consider quite interesting. When we look about what countries have been asking for support to either us at the International Center for Tax and Development or at the African Tax Administration Forum to increase a net worth individual, the quality of democracy is not a predictor in any way. Okay, of the 12 countries that have asked for support, if we look at the Polity 5 kind of quality of democracy, 6 are considered open democracies, 6 are between open and closed democracies, so what we call illiberal democracies in general. So at least in low-income countries, the revenue pressure and the international context they interact in is a much stronger predictor of an interest to at least consider that, and whether you do it or not is a different question. On taxes better than bribe, I have heard that before. And I agree that we should not try to convince people to pay their taxes, but at the same time, what we always suggest is to, especially with a net worth individual, is to start with cooperative compliance, because these people can hire the best auditor and the best lawyer in the country and then can bring the revenue authorities to court forever and ever and never pay anything. The couple of things that have somehow shown some promise are quite funny. One is to have Taxpayer Appreciation Day, where the president and the prime minister and whoever else does a public tax declaration, okay, in front of everybody, signs it, submits it to the revenue authorities, and it shows that they can lead the way. And that has some kind of impact then of everybody else's, because, if the president does it, then I have to do it too. And the other thing is something that actually was starting to come out from Colombia about, I think, 10, 12 years ago, and is earmarking some of the revenue from the top marginal rate or from wealth taxes towards particular services that are of interest to a net worth individual. Now, I think there are ethical problems there that one can consider, but that could be a way, right? You can pay for security, you can pay for internet, for electricity, for the kind of things they would have to pay for themselves privately. Start there, catch them in the tax net, and then eventually forget about it.
Okay, so plenty of provocation there, I think. We have time for one or two more questions. Yeah. And anyone else that I'd kind of like to know now? Yeah.
Hi. Giovanni's last remark made me think that it would be interesting to know, not only in Africa, but also in the European Union, and maybe in other parts of the developed world, is there a correlation between democracies' various levels and tax systems, since it would rather correlate with the topic of our conference? If you can make some remarks on that. I can only say, for the example of Hungary, I do not consider it to be a normally democratic country anymore. And our tax system is rather perverse. And it's been that way sneakily transformed during the past 15 years. And I try to perceive what is the average standard in developed countries, since I used to work in the OECD. And I see that this type of sneaking reversal of normal functioning of democracies is taking place in many countries. We are seeing very blunt examples in the United States now. And that makes me make a comment that I do not agree with not persuading the rich. Maybe you're correct, we should not persuade them, we should oblige them by law and enforce these laws so that they can participate. I can only say that the enlightened part of the rich, like Warren Buffett or Bill Gates, every now and then communicate that they would be ready to pay more taxes should the state demand it. I would like to see more of these people come out. Thank you.
Yeah, thank you. I really enjoyed all the three presentations, and I'm not an economist at all, so I have a very general and naive question. But my understanding is that one of the obstacles that doesn't allow us to effectively tax the rich, the super rich, is that countries compete for their investment, right? So they have an incentive to not tax them, right? So what do we do about that? Thank you.
So 2 minutes each. Feel welcome also if there's any other final comment that really needs to get out there to add that on. And maybe we start with Giovanni this time and we go in reverse order.
I'll start from the last one. Okay, I think that there is undoubtedly tax competition, and I think that some of the work that the OECD has been doing for global minimum tax, or the proposal of the Brazilian G20 and Gabriel Zucman last year, was to try and create a level playing field across the globe. Now, that is clearly the way of conceiving it. How you then distribute that revenue is the problem, right? Like, to a great extent, the hope of a lot of low-income countries right now is the United Nations Tax Convention. It's the whole process that's taking place at the United Nations, which is hoped to derive to some sort of rule of agreement that can lead the way for something that will eliminate the incentive to compete over tax rule. The OECD has been trying for a long time, but the OECD is not really seeing as a very democratic space by low-income countries. They didn't have enough of a voice to feel like they were driving that conversation. So that's where the hope lies. On the need of looking at democracy and taxation, I think that's interesting. I am a development economist. I look at low-income countries, so I will let the others speak on that. My final remark would be that it doesn't matter if you are in a high or in a low-income countries. There are a lot of things that people can actually do tomorrow to start making high net worth individual pay more taxes. The political will from the center to make that happen is what really is key, more than any other technical complexity. And the role of places such as this and civil society is to master that political will.
Yes, the question of investment is indeed the typical question, and good question, because it's always raised by the business lobbies in the sense, if you tax us, we will not invest. But I think there's of course, we cannot, in the sense, take away the investment incentive by capturing all the money a capitalist can earn on its investment. But the special thing on corporate tax is you pay it only when you make a profit. If you don't make a profit, there is no corporate tax to pay. And even you can accumulate losses for the next year and the years after, where you also will not be paying corporate tax. So corporate tax only applies when you make profits, and this is what investors are interested in. And as long as they can make profits, they will invest. So I think we shouldn't be too scared by this argument because we have seen 3 decades, I think, of trickle-down economics, where the richest or business lobbies make us believe if they get richer and richer, some income will trickle down to the rest of the society. And we have come to a Europe of economic stagnation, basically. So I think there is an argument for changing the recipes that we have been applying for 3 decades. And let's maybe try something else.
Thanks. Maybe I can add to Sarah's last remark, because the investment argument, it's often formulated, but what it really does is it reduces the contribution of the business owners and the rich to the common good, to them providing jobs. And it would be interesting to see how that discourse has historically actually evolved, and when that economization of the notion of what's a contribution to the common good, a valuable contribution, has happened. My suspicion would be it must have been somewhere in the 80s, but I think that's asking too little of them. I think we should be asking more of them. We should ask them to make, non-economic contributions to the common good, and we have to enforce these contributions. And with regard to I mean, that maybe also relates to tax morale or to the willingness, or should we oblige them? Should they be more willing? I mean, we know in general that tax morale is higher in countries where there is a strong quality of public services and where quality of government is strong. So I mean, that's how the Scandinavian countries maintain their high tax equilibrium, basically. So, but if you level high taxes and the service you get is Deutsche Bahn, then of course you're in trouble. So in a sense, I think improving public provision and maintaining an adequate funding base or revenue base for that somehow go hand in hand, and we have to find a way into a stable sort of equilibrium where we have both of them in good shape, actually.
Well, I want to thank the panel. It was really stimulating, and I think we've got a surprising, I thought we'd be very obstacle focused, but I think we got quite a lot of really good answers to both how and why to tax the rich, the super rich, and the billionaires. So please give them an applause.